New results from the Delivering Alpha quarterly stock report. 55% of investors surveyed said the Fed was right to get more aggressive. 21% said the current path is more likely to hurt stocks than help the economy. Joining us now to talk about the Fed's path and how to prepare your portfolio for Q3, Cameron Dawson, Chief Investment Officer at NewEdge Wealth. Cameron, great to have you with us. Good morning.
Good morning.
Powell's basically said that it is the most important thing to get back price stability. And that a recession could be a byproduct effectively. And I'm wondering, how do you invest knowing that that is the ultimate objective, price stability or reining in inflation?
Yeah, I think we have to invest knowing that we're stuck in this downtrend in this world of higher volatility. Because as long as the Fed is fighting inflation, as long as they're removing liquidity from the system to fight inflation, it means that each of these relief rallies that we have likely fails at resistance and we roll over. So all these hope trades that we've seen the bottom and that the worst is over, or at least we're moving into a new bull market, likely are way premature, given the fact that the Fed is saying, and actually all central banks at the ECB forum yesterday, they're saying that they're willing to tolerate lower growth. They're willing to tolerate unemployment. They're willing to tolerate a recession, all to keep those inflation expectations in check, which just means equity markets will continue to be volatile.
How do we think about the valuation of the market, Cameron? I mean, I'm thinking about the warning that we got from Restoration Hardware, RH, last night, and they issue this warning where they take down second half of the year, full year forecast, basically, because of rising rates. And they do this just 28 days after posting their own earnings and giving guidance. And this is not the only company that's revised so quickly their forecast due to quickly deteriorating conditions. How are we to even believe the guidance that is given what a Target is saying, a Microsoft, Snap? These are all companies that came out after posting earnings, just within 30 days, revising lower their forecasts.
Well, clearly the environment is changing rather rapidly, and we're seeing this tightness come through where in aggregate, S&P numbers for earnings estimates have not come down. They're still at 10.5% growth for this year and 9.5% for 23 and 24. So as we start to see this weaker data come through, we think estimates have to get cut, not just from the guidance, but analysts need to cut estimates as well. So the end result is that when we look at valuations, yes, they've come down from 22 times to start this year to 16.5 times, but that's just about average. Usually in tightening cycles as well as in recessions, you see valuations go well below average. And so we think that we have downward pressure on equities from the earnings front and the multiple front from here, which is why we don't think that we've seen the low yet.
So what's the case to make to individual investors or investors at large out there to be in the markets right now, given all of what you've said? It sounds like it's, you don't want to fight the Fed. It's a terrible environment. Things are quickly changing. Companies don't even have a grasp on their own forecasts. Why should investors?
Well, I think investors need to take into account the bigger picture, which is that they have to care about taxes. They have to care about long-term compounding growth. And I think that the biggest mistake that investors can make, and one that tends to destroy value for the long run, is selling after a major correction and then being too scared to get back in and missing the start of a new cycle. So timing that is really difficult. So staying invested remains important, but I think that it also means that we have to be able to shift where we have exposure within portfolios. We do not want to have too much exposure to high growth, high valuation names that are the most sensitive to the Fed removing liquidity. Those names still have room to have multiple compression. And so we think we need to stay in portfolios that have high quality, that have good balance sheets. And really, those are the kind of quality compounders that you want to scoop up at lower valuations, because those will be the core of your portfolio as you move through the next cycle.